Ladies and gentlemen, good day and welcome to Matrimony.com Limited Q2 FY23 earnings conference call hosted by Yes Securities. We have with us senior management of Matrimony.com on the call, Mr. Murugavel Janakiraman, Chairman and Managing Director, Mr. Sushant Pai, Chief Financial Officer. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Murugavel Janakiraman, Chairman and Managing Director, Matrimony.com. Thank you, and over to you, sir.
Thank you so much. Good evening, everyone. I hope all of you are continuing to stay safe and healthy. After many quarters of good growth, we have seen a subdued quarter due to intense seasonality. However, we are confident of overcoming the challenge and move to better growth with our new launches and with our new focus on the customer side, and we are very confident of bouncing back on growth. Now let me come to the results. In quarter 2, on a consolidated basis, we have achieved rupees 109.1 crores in billing, which is 2.2% year-on-year growth. Revenues were rupees 114.9 crores, which is a 4.5% year-on-year growth. Key insights and highlights for the matchmaking business in Q2 are as follows. Billing at rupees 106.6 crores, which is a growth of 0.4% year-on-year. Revenue at rupees 102.5 crores, growth of 3%. 112.5 crores, a growth of 3% year-on-year. We added 2.4 lakhs paid subscription during the quarter, which is a growth of 8.3% year-on-year. AP for the matchmaking business declined 3.4% quarter-over-quarter and 7.2% year-on-year. This is in line with our customer acquisition strategy. We continue to track the impact that we create for our customers. We are happy to state that we have created about 20,955 success stories in quarter 2. Now coming to marriage services business, revenue was rupees 2.4 crore, a growth of 30.6% quarter-over-quarter and 202.9% year-on-year. Loss in the quarter was rupees 3.3 crore compared to rupees 3.4 crore in the previous quarter. I'm happy to state some of the important milestones in the quarter. We launched Rainbow Love, an exclusive matchmaking app for LGBTQIA+ community to help them find a meaningful relationship. We launched Matrimony, an exclusive matchmaking service for the IT and software and technology professionals to help them find a match from the same professions. Bharat Matrimony won the Exchange from India Pride of India, the Best of South Awards 2022. Bharat Matrimony Pele Padai Pil Shadi won the Voice of Change recognition at the INBAA Awards. On the billing and revenue outlook for Q3, matchmaking billing will grow by single digits because of the impact we had in quarter 2. It takes one more quarter for us to bounce back. We expect to bounce back to double-digit growth in quarter 4 onwards. On the wedding services, the momentum we expect to continue. We expect to grow at a triple-digit basis. The losses, however, will be at a single level that of quarter 2. Let me now pass on to Sushant to comment on the key profitability items. Sushant, over to you.
Yeah. Thanks, Muruga. Our EBITDA margin for the matchmaking business in Q2 is at 23.1% as compared to 23.5% in quarter 1 and 29% a year ago. Marketing expenses are at rupees 44.4 crores as compared to 43.5 crores in Q1 and 39.9 crores a year ago. Excluding marketing expenses, our margins in matchmaking are stable at 63%. On a consolidated basis, our EBITDA margins in Q2 are at 16.3% as compared to 17.6% in quarter 1 and 24% a year ago. Tax rate in the quarter is at 14.3% as compared to 21% in quarter 1. The tax rate reduced, which is the ETR, reduced to lower tax on realized gains on mutual funds which were redeemed to fund the buyback amount. PAT is at rupees 11.7 crores, a decline of 2.2% quarter on quarter and 29.3% year-on-year. Share of profit from Astro is rupees 12.5 lakhs. Net profit margin has been stable at 10% plus levels for the last 4 quarters. Return on capital employed annualized for the quarter is at 19.5%. We completed the buyback of shares extinguishment by 26th August 2022. The buyback cost, buyback taxes and expenses are accounted as reduction from the equity during the quarter ended September 30, 2022. The buyback program was successful with 759% subscription, and all the shareholders who tendered their shares were accepted for the buyback depending upon the proportion of shareholding. Since the promoter group did not participate, it added further to their entitlement. On the outlook for Q3 margins, we expect Q3 EBITDA and PAT to be slightly lesser than the levels of Q2 due to the revenue impact of lower billings of Q2. I would like to end with the customary safe harbor statement. Certain statements during this call could be forward-looking statements on the business. These involve a number of risks and uncertainties that could cause the actual results to differ materially from such forward-looking statements. We do not undertake to update any such forward-looking statements that may be made from time to time by or on behalf of the company unless it is required by law. Over to you. We can open for the Q&A now.
Thank you very much. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Vivekanand Subramaniam, Ambit Capital. Please go ahead, sir.
Hi, thanks for the opportunity. I have 2 questions. So one is on the billing trends. It's well below the guidance that, or rather the aspiration that you have of double-digit growth. Muruga, you said that seasonality was particularly bad. I am just trying to understand this better because my sense was this segment, the online matchmaking segment, was a fairly small part of the overall matchmaking activity that Indians do. So in that context, why did seasonality hurt us so much? So that is question 1. Secondly, as far as your strategy is concerned, couple of years ago you had chosen to follow a path where you would segment your pricing based on the educational qualifications and the and also the place that the people are subscribing from, and that was one of the factors that had led to transactions increasing to over 2 lakhs per quarter, but now it's stuck at that, right? Compared to last quarter levels, this is a small improvement year on year, but still you would argue that this improvement is definitely not something that would make you proud, right? So could you talk a little bit about the strategy that now you are following, and it's been 2 years since you followed that pricing led the segmentation led model to increase more transactions, but mixed success there. Thank you.
Thank you, Vivekanand. So let me talk about seasonality first. The seasonality is definitely has an impact on the matchmaking business because when people look at starting something on the matchmaking, people do look into the auspicious period, and people some personal people abstain in the matchmaking, abstain from the matchmaking process. The Q2, in particular, look at the south, we have something called in Ashadam in Andhra, and Adi in Tamil, and also in North India, the short period. So this is again, it's a cut across the regions. During the period, we definitely see that activity goes down. So again, it has been look at last so many years of a trend. There are some years we are able to overcome because of the different reasons, but either could have launched something or during the period or some other factor would have contributed. But if you look at the historic trend, the Q2 always definitely lower than the quarter one. But look at year on year, this time for whatever reason that the impact was severe. So it was much more than what we had anticipated. So this quarter definitely came as a surprise in terms of the customer behavior, in terms of the profiles and the conversion had an impact. So while definitely your Q2, seasonality-wise, it's definitely it's a low quarter for the matchmaking business. It tend to go down because of the reason which already explained. So, but again, as I said, we had a severe impact on quarter two. However, actually, things are definitely bouncing back, and while this quarter we cannot hope to achieve double-digit growth, but the way things are looking, definitely in quarter four we can move to a double-digit growth year on year. And come to the pricing strategies. The pricing strategies are based on various things. To look at maybe education or socioeconomic side and various factors. We look at our while that the billing was sort of subdued, but still we managed to achieve a 8.3% the billing growth. So again, we're talking about from last year from 2.2 lakhs, we're talking about 2.4 lakhs. It's almost addition of 20,000 paid sanctions in a quarter. So that's that's a reasonably good growth and all. But we continue to employ the pricing strategy because it's not all the customers are same. That's the right strategy to do. However, while we definitely seen that the paid transaction moving up in terms of compared to what it was in the past, however, we definitely can get better on the paid transaction.
Okay, that was helpful. Just one follow-up. So, since seasonality had impacted our business very adversely in 2Q, would it not be fair to say that 3Q would be a strong bounce back, at least in billing terms, given that there would be some pent-up demand? Because going by your logic, people seem to have postponed their decision of, let's say, signing on to paid matchmaking services because of inauspicious days and across the country. So I'm just trying to understand if 3Q could be substantially better from a billing perspective. Revenue, I understand. Revenue growth will be subdued, I understand, because of weak billing in 2Q.
So in terms of the billing also, because the good percent revenue we get from renewals. So if there is a drop in the revenue in the billing, it also has some kind of impact on the some part of the business, which is the renewal part of the business. We get good customer revenue coming from the people renewing the subscriptions. So definitely that will impact on the renewal side. So again, the pent-up demand, again, the people, there's some drop happens, there's a bounce that happens. It's not there'll be a strong, the pent-up demand, and all. There's been again year on year the similar level of the growth in terms of people coming up that will happen and all. So we expect this quarter also the growth-wise, yes, definitely. While we don't see a double-digit growth because of the reason which already explained, but however, we expect to move to double-digit growth only from quarter four onwards. Because first we need to catch up on the growth trend, first we need to increase the fresh conversions in the quarter three, and then when we move to quarter four, we can move to double-digit growth.
Right. I'll ask one last question, which is on the business model itself. So, one of your competitors, which is listed, they have chosen to follow a model where now they are moving to more freemium than what you currently offer, which is chat being free, and they are trying to increase traffic for the category, right? For their site, and of course be more relevant in the category. Separately, they are also investing in a serious dating website, indicating that they want to try multiple things here to get growth. In that. On those lines, is there something that you are also trying to do which can, because this segment is clearly growing much slower than what one would expect of a deeply underpenetrated online classified segment?
In terms of business model, continue to remain what is the way we are doing. We think that's the right way to do. And in fact, for us, that the revenue drop has been the same across the market. It's not that we have seen any significant drop in any part of the market. So far as things continue to look the same, so we are not seeing any impact. So for the business model, the way business model we have been operating as a leader, and we think we continue the business model. In terms of overall the category growth, I think that the category has been growing at certain percentage, 10 to 15%. That's the kind of growth. Again, while we are taking steps to after the growth, and we are taking some of the initiatives and commit our strategies. We had a reasonable bounce back in the last 4-5 quarters, while Q2 was one of the quarters. We hope to bounce back, in the Q4 and move on to double-digit growth. So yes, I agree with you that there are some challenges because one of the reasons that this category also had some of the intense competition, but I feel that sort of things seem to be probably coming to a stage where we see that the competitive impact will just continue. But again, the strategies, the steps what we are taking, we believe that we could be able to move to a better growth in the coming quarter.
Okay, thank you and all the best.
Thank you, sir. We take the next question from the line of Prakash Kapadia from Anived Portfolio Managers Private Limited. Please go ahead, sir.
Yeah. Thanks for the opportunity. We've seen the second quarter in a row, EBITDA has actually declined for us. And if I look at, pre-COVID trends, revenues are much higher than, pre-COVID, but we are seeing advertisement expenses of almost 45 crores, which is much, much higher. So what is leading to this increase, despite, we being industry leaders, shouldn't we, drive growth and manage our profitability by, pricing, revenue potential and bit of cost management? So, looks slightly confusing to me. So where are we heading? Because, ad expenses in a muted quarter are also so high. So, one would guess if sales or, billings are weak, we could have or, we should have ideally cut down on some of these expenditures. So what is driving this and, what's the outlook on ad spends in the coming quarters?
See, the ad spend we expect to continue at a similar level. While we understand that Q2 was one of the challenging quarters, probably we have managed that marketing expenses because, again, the sort of seasonality came in the middle of the quarter, so we thought that's the right thing to do, continue the marketing spend because sometimes the profile acquisitions also helps in the coming quarter. Also, we don't want to further impact that this quarter, which was already seasonally a weak quarter. Again, as I said, we didn't expect this kind of impact on quarter two. So this quarter, for strange reasons, that the impact was much more than what we had seen in the past. So, however, the marketing spend for us will be continue to remain at this level because we see that one thing that we have multiple brands to manage. There's also that the marketing spend by competitors continue to remain high. So important that we believe that continue to operate at similar level. So while we are definitely working on our strategies and steps to drive the growth, again, the way currently we look like the marketing probably remain at this sort of similar level, and we are now hope from now onwards we could be able to drive the growth and now achieve progress. The increase in billing that translates to revenue would help us to get a better margin on those things. Yeah, we definitely, this quarter was definitely a disappointing quarter, but however, we are confident of bouncing back on growth and all that thing. But however, the marketing spend remain at that level only. And in terms of other costs, I think as a company we are definitely operating at a very efficient business. So continue to look at the ways to optimize the cost, and so that's always been the case. So I think the important priority or thing what we are working on is driving the growth in all.
So the only way to offset some of these higher ad expenses is to get higher revenue growth, which at least you alluded next quarter could be slightly challenging, but Q4 onwards that double-digit revenue growth has to come in to offset some of these expenses. Otherwise, profitability improvement could become a challenge in H2.
Yeah. So yeah, I think the growth definitely, the billing growth that need to definitely move up. Yeah.
And from the revenue side, you did mention some of the factors in terms of seasonality or some of the inauspicious days. So was it in south of India only, or this was witnessed in some of the other markets? And also you could give us some sense of what is happening, say north, west, or non-south markets. So what is competition doing, or what are we sensing in some of the other markets except south?
No, far as again, seasonality is across India. You may know that in north there is a period called Short. So during the period, people are staying from on maximum play activity. Again, only there are certain persons. Not that everyone decide to take a break and all. That during the period, definitely you see that the profiles registration goes down because there are people who are very religious or sentiment about these things. There are certain percent of people. So it's not that the entire India or all the people across India. It's only certain percentage of people. That's the reason why the drop is only a few percentage. So, and again, it's only during it's not entire quarter. Even Tamil Nadu is for a month, and Andhra is for a month. North is for 15 days. Again, it's across region except some pockets of some region in India. It's very limited. Kerala, Andhra, not too auspicious about too sentimental about these things. So it varies from market to market, but some other market the sentiments are definitely very high. So for us, the drop is not limited to any particular region. It's across India we've seen the drop. So that way it's a broad base, and so it's not one geography versus the other geography. So that way the impact was quite spread.
Understood. Thanks. All the best.
Thank you.
Yeah, go ahead. We are not able to hear the next question.
Hello?
Yes, please go ahead.
Okay. Hi, this is Sonal. I'm assuming I'm audible.
Yes, you are, please.
Yes, sir. Sorry, there was a lag. So, sir, I want to focus again on marketing, and pardon my knowledge of the business, but understanding from a marketing perspective that if I consider H1 to H1, if your, let's say, marketing spend has gone up by like whatever 12, 13 odd crores, typically in common sense is that we expect like a 3 to 5x kind of a ROI on the marketing spend, and hence let's say the top line ideally would go up by 30 to 50 odd crores, and that's what I've learned from just attending FMCG calls essentially. Now I am just putting that common sense in here, that if that kind of a throughput is not expected, or you see a softness in the market, there are two ways where you see maybe we need to change the channel, or we maybe need to cut down the marketing budget. So what's it going to be if, let's say, your marketing burn remains the same as what it was right now, it doesn't go up, and you generate more cash, maybe your top line is not growing what you want it to be, but and you actually tighten your funnels on your marketing spend, the ROIs actually become better. Is that something which on those lines company, I'm assuming you do think, but I'm just trying to, I think, open a discussion or dialogue here to just understand how you guys think about marketing. That's part one of my question.
Sonal, so today, well, definitely marketing spend one of the large part of the expense. And the most of the marketing spend are towards on the brand side. So again, so the marketing spend has gone up on account of multiple things. One is today we have multiple brands, and also we've seen that in the category spend has gone up substantially. So that now we need to sort of defend our market position, to defend our leadership. So that led to the increase in marketing spend. The thing is that while by reducing marketing spend, while it can have an immediate impact. However, if we don't defend our marketing, our reach or our leadership with the way of some increased marketing, because since the category marketing spend has moved up now, it can have some kind of long-term impact and all that. So important things, that again this category going through that intense competition, the spend has gone up. So we have to step up the marketing and all the thing, while dropping the marketing 1 or 2 quarters, while the adverse impact may not be won't be that. But however, we believe that the long run it can have an impact on all the things. But it is important that we have to kind of operate at a certain level of visibility to ensure that we continue to remain at level of leadership. So that's why the marketing spend has gone up. So again, most of the marketing spend are the brand-led marketing things. So again, while the digital mix has been increasing, that today the good percentage of our the marketing move to digital. Our large part of marketing spend continues to remain our brand building. So as we progress, when the competitive intensity or the marketing spend for this category comes down, that point of time we could be able to operate around at a less marketing budget. At this point of time, considering the category intensity on the marketing spend, it necessitates that we need to operate at a certain level of visibility on the marketing spend. Plus, also add to the thing, we have multiple brands compared to other players in the market. That also added to the increase in marketing spend. So maybe a couple of years down the line, when that some bit of the slowness or comes to a certain level of marketing spend, then that point of time we could definitely be able to reduce the market spend.
So, sir, if I were to just understand this now, just double-clicking on what you've explained, even branding can be done on a performance basis, if I understand the marketing correctly. So has our customer acquisition cost, it would have gone up because it's not converting into similar top-line growth. So is it so that our customer acquisition cost has gone up significantly, maybe YOY or over the last 2-3 years?
The good thing is, Sonal, most of our customer acquisitions are organic. That's the strength of the brand what we have built. So while acquire millions of profiles, and so most of the profiles are organic. There you don't invest money on acquisition. So that's the strength of the brand. So in most of the areas, the brand is synonymous with the category. So while certain percentage of marketing spend goes for digital, where we monitor the ROI and other things. So in terms of while the brand building, can the brand building done only on digital? No, our category, we definitely see that at this point of time, the TV advertisement is necessary. Again, as you speak, the things are changing. In India also things are changing rapidly now. So always the question is what percentage digital, what percentage need the TV and all those things. Because marketing become all the more challenging and complex as well. 5 years ago, 10 years ago, marketing used to be fairly simpler. Today it's increasing multiple channels, OTT, many things. The marketing definitely become a challenge now. However, as I said, because of the brand being so strong, the majority of the profile acquisitions are organic. We definitely look at the various things like profile acquisitions and ROI, everything is measured in all the things. However, in terms of the TV spend, when you get the money, it's not that you're going to get the substantially increasing profile, and so yes, digital definitely look at the spend and how you look how the ROI and all. Definitely those things are measured in all the things, and the right steps are being taken. So while there's always people say, can the brand building can be done only on digital, but as I said, at this point of time, we require the combination of TV plus digital as the best way forward. But after progress, things may change. Right? So things are changing, you are sometimes need to contemplate what is the right mix of the spend and all those. So.
And sir, how I'm assuming a large part of our customers would be acquired online, right? More than 90% customers acquired online. Is that correct in understanding? Just trying to understand the funnel, how the acquisition funnel works here.
No, it's a completely 100% non-digital, so it's nothing like any offline acquisition. Everything the customer needs to either download the app or register through online.
So I'm sure this would have, and I think you do have physical outlets as well. But just trying to understand, is the customer acquisition cost cheaper in your physical outlets or customer acquisition? Because online, I think the customer acquisition cost have been going up significantly given COVID, given attention spans.
Sorry, I forgot that. Yeah, that's the point. Definitely no online acquisition cost, because I told you most of the profiles, are organic. They are not investing money on acquiring those profiles. However, we do spend money on digital. That includes our brand keyword as well. And definitely the costs have gone up because there is an increased competition for our brands as well. So that's also definitely has gone up in the last couple of years because of the bidding costs have gone up for the keywords and all that. Yes, definitely the cost of profile acquisition digital also gone up. However, the physical outlet is not the insignificant part of profile acquisition. When people walk in retail outlet, they go for paid transactions. So that way, the physical outlets are not meant for profile acquisition. They are mainly meant for customer acquisition or paid subscriptions.
Got it. Okay. Thank you, sir. Thank you.
Yes.
Thank you, sir. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 on the touchtone phone. We take the next question from the line of Nitin Sharma from MC Pro Research. Please go ahead, sir.
Hi, thanks for taking my questions. 2 questions, if I may. First of all, on the marriage services segment, I think EBITDA loss is back at the pre-COVID levels, but revenue seems to be still lagging a bit. Can you please provide some color on the progress on this business, and what are the typical challenges you are seeing in this segment?
So definitely wedding services definitely have been growing, and we expect wedding services to grow at a triple digit. Now we have been seeing the benefits of the integrating Shadi Saga into Wedding Bazaar, and we definitely seeing that the increase in traffic, increase in leads, increase in acquisitions. So the outlook for wedding services, the growth is expected to continue at triple digit basis. However, you know that we are still in it's a small part of our business, but it's growing at a healthy stage. So, but the losses will be at a similar level, and if the growth continues this way, and we are hoping, confident that we'll continue the triple digit growth, I think the losses as we progress will come down.
And any challenges you're seeing in this segment?
I'm sorry?
Any challenges you're seeing from the competition in this space?
It's a progress. I think challenges are, this category again, there are multiple service providers in this category. You have a makeup artist, photographer, caterer. Again, the different service providers convert at a different level. Some of the service providers, they rely more on online, so we could able to convert. So some other categories, the conversions have been challenged. So again, that's totally not a single service provider in this category. There are multiple service providers. So service provider like a photographer, a makeup artist, and they are really unorganized. And converting them online, it's a fairly relatively easy, and we see definitely good traction on those segments. However, some of the categories within the wedding services, like say jewelers or apparel and all, they have the brand and converting those categories. And some of the categories like caterers and all, it's not like they don't convert the like of the photographer and all. So again, the multiple service providers, they all convert at a different level. Again, this category has been evolving, and we definitely have to be done and to increase the level of satisfaction, increase the renewal rate. But the thing is that obviously, it's an unorganized segment, and we definitely see opportunity to continue to grow the segment. While there are challenges, we achieved progress, we could be able to improve and address those challenges. So more of it's a progress. Any this business still in the early stages. A lot of work to be done, and on the product side, service side, and on the value delivery side. So we need to improve on all these areas so the vendors see the benefits of being a member of or paid member of paid service provider of wedding services, and then able to retain and be able to charge more, achieve progress. So yeah, well, there are challenges, but again, having said that, this business has been progressing well.
Right. And the second question is, can you help us understand what kind of traction you are seeing with the Jodi app paid registration? Any data would be helpful. And also while at it on the ATV side, would like to understand how your premium subscriptions are doing. If you can again share some growth related data, that would be super helpful.
Again, Jodi is in the early stages, and again, as a company, we don't give a break of individual segments, but again, Jodi is definitely in the early stages. So we continue to experiment on that segment. Personal services has been sort of fairly progressing well. So as I said, while we see definitely some kind of growth on the segment. So, but again, it's a company we do not have at this point of time kind of individual segments for competitive reasons.
Thank you.
Thank you, sir. Participants, if you wish to ask a question, you may please press star and 1 on your touchtone phone. Participants, you may press star and 1 to ask a question. We take the next question from the line of Vivekanand Subbaraman from Ambit Capital. Please go ahead, sir.
Thank you for the follow-up opportunity. Muruga, you have been raising concerns in the past with the government on Google's App Store policies. Now that the Competition Commission has ruled against Google, do you foresee any benefits for your business and the industry? And further, being a seasoned veteran in the tech space, would you be able to comment on the larger implications on the domestic tech space? That's one, and I have one on our business also, which I'll ask after this answer.
Thanks, Vivekanand. It was a good verdict by CCI. So basically what Google wanted to mandate was that the companies who are operating a digital business in India, digital service providers, that they have to use Google in-app billing system. And what is the meaning Google in-app billing system is that you have to pay certain percentage of transaction money to Google. Again, vary from category to category, and the Google expectation or what is it, again, for some of the category like category like us, so it was 15%, or 50% billing will go to Google. Even otherwise that, initially it was the Google's mandate was that only you have to use the Google in-app billing payment, and later they said you can also use other service provider. However, if you use other service provider, you have to pay 11% commission. What it means is that suppose you use that payment gateways like say RazorPay or PayU or other CC Avenue or other various payment gateways, where the charge is around say to 2%. But again, Google in-app billing was around 15%. So this is thought, obviously Google was abusing the dominant in that in the Play Store ecosystem, because today almost 90% of the downloads are happening through the Google Android Play Stores. So we took out the CCI because the Google more of insisting that the companies operating digital services they need to use only the Google in-app billing, or even otherwise to use other payment gateways, they have to pay the commission all the time. So this is more like a Google tax. So again, you have seen that CCI a bit, and so it's kind of definitely abusing the monopoly, and CCI slapped a fine on Google, and Google decided to pause. So we have to see whether what Google is going to take. So if Google go to NCLT, we also go to NCLT. There are startup players are kind of fighting against this one. What kind of implications it cannot in the ecosystem? More like a taxing the company. So how the government tax on GST 18%, Google want to tax 15% or 30% revenue. Again, these are limited. These are only for the company operating digital goods and services. Obviously, they cannot charge additional 30% on companies offering an e-commerce product or say Swiggy or Zomato. So they kind of conveniently chose this only for the company operating digital, like tech company or digital services company. Okay. This is something Apple has been doing, and then the US and the Google try to follow the similar thing. And globally, there are so many cases are going against both the companies. In South Korea, again, told Google that they cannot do that. So again, it's a good revenue opportunity for Google. They are trying to both Google and Apple trying to leverage dominance to take 15 to 30% of the company's revenues. It literally transform into a tax. Okay, without putting an additional service there. Okay, and it's only limited to digital companies because they can't charge similar kind of revenue for other companies. So thankfully that CCI kind of doing the verdict now. The impact for Indian companies it's a kind of almost you paid 15% or 30% revenue to Google. That definitely increased the cost of running the business all the thing. So so again, I don't think that it's the right thing for Google to do, that charging 15%, 30% of billing, just for forcing people used to use the Google in a billing, or even otherwise pay commission on using even if you use other payment company. So it's how the impact on the Indian startup ecosystem. So yeah, the startup companies are definitely against it, and they've been fighting for it, and thankfully kind of the CCI also vindicated our stance on this one. So yeah.
Muruga, thank you so much for the elaborate explanation. Does this have any bearing on your realization? And if you can talk to us about the proportion of transactions that happen directly through the Google payment system or through the other billing modes that you could have used, and is this going to have any financial bearing on our business?
No, because we don't use Google billing payment system. We use the various payment gateways, so that the commissions are ranging from 1.5% to 2%. So there's no change for us, no benefit or no change, because it has been the way we have been operating. That way, every insurance company operates. We use various payment gateways to compute the transaction. While the UPI is more, that transaction is less. If it's a debit and credit card, the transaction fee is slightly more, but again it's around 2%.
Okay. My second and last question is you are running your matchmaking business profitably despite hyper competition, resulting in depressed ATV and very high ad spends. So why not deploy more money in wedding services to chase growth? I mean, that business you seem to be targeting a category which is very, very underpenetrated, even more than your matchmaking business. Could you give us an update on the business model? Any metrics that you are tracking in terms of traffic or monthly active vendors, or let's say the monetization there?
No, we are today India's largest wedding service marketplace. We have 1.5 lakh service provider on weddingbazaar.com. So again, the integration happened just couple of quarters, 1 or 2 quarters earlier. So we are seeing the benefits of the integrations, and working on increasing listing, working on increasing the traffic, and we want to get to a certain threshold or certain milestones. Then we decide how do you want to take this business forward, because we believe that whatever things we have done, we want to realize that the benefits of the integration. We believe that we could be able to drive the revenue further in the way we are operating, get closer to the profitability, then we figure out what is the next course of strategy and all this. So at this point in time, I think the plan is to drive the growth, get to the close to the break-even, then figure out, then work on the next phase of growth and all those things. So rather than investing much more on this category, because what are the investments we have done are done good enough for the kind of growth what we are seeing all the thing at this point in time. As I said, let's wait probably maybe a couple of more quarters down the line. Then we can figure out work on what to be done.
Great. Thank you and all the best.
Thank you very much.
Thank you very much. A reminder to all the participants, if you wish to ask a question, you may press star and 1 on your touchtone phone. Anyone who wishes to ask a question may press star and 1 at this time. As there are no further questions, I now hand the conference over to Mr. Murugavel Janakiraman for closing comments.
Thank you all for joining this call, and look forward to speaking with you during the quarter. If you have any questions, you can write to us. Thank you once again.
Thank you so much. Thanks.
Thank you. On behalf of Yes Securities, that concludes this conference call. Thank you for joining us, and you may now disconnect.